because it's my experience that if PMI doesn't waive deficiency, they are going to sue you.
Yes.
That's not a maybe, it's a win. And I have also seen that a lot of times when you're negotiating, there is PMI, they're going to want contribution.
They do. They always do. And are they going to let up on that? I haven't had anyone let up on it.
No.
They're just not. And that's why I say when we get so deep into the short sale and then we find out in the 11th hour that this has insurance.
Right.
Now we've got a whole new fight on our hands.
Right. And just to separate it, keep it simple, private mortgage insurance, most people are very familiar with. That's when you don't have 20% to put down, and you're not doing a VA or an FHA. You're almost always going to have private mortgage insurance in that scenario. When you do FHA, it's actually there's a government similar type policy, but it's a partial claim. So they're going to usually satisfy a certain portion of the arrearages, but it's not the whole amount. There's also mortgage insurance that is on the backside of the securitization market, which has absolutely nothing to do with the short sale. Well, I don't know whether there's that insurance on your loan. She doesn't know. Nobody knows. That's between the investors and whoever packaged from the warehouse, whatever the MBS was. So whenever there's this issue of insurance, just make sure if there's private mortgage insurance that's paid up front to insulate the lender who did a non-conventional loan, where they were allowing you not to, the sign and drive where you don't put any money down. You're almost always going to have mortgage insurance up front that's either being taken out of your escrow or is added onto your mortgage statement and would be on there. You could see it.
You can see it clearly, yes.
Right. That's the insurance that we're talking about, definitely wanting them to be sitting at the table with regards to the short sale negotiation. The other insurance, the mortgage-backed security insurance, is on the pool of loans, and it has to do with claims that are made on the defaults of the loans and the losses, so the investors are insured for those losses. There's not going to be a subrogation because you're not a party to that contract. There's no privity. So the fact that you defaulted while they have a damage from that, that's not how that insurance works. And so when we talked about earlier in this webinar about whether the lender will be able to pursue a certain amount of indebtedness and that there would be an offset for insurance, that's the insurance I'm talking about, is that because they wouldn't have that subrogation claim to bring.
Right.
So, all right, let's move on to the next question. I think we got that one satisfied. Oh, there's another one. Okay. And yeah, usually when you do negotiate PMI at a short sale, you're going to have to come out of pocket. Yeah, almost always.
And they seem to have a magic number of about 5,000 to 10,000.
Yeah.
They just pick it out of the sky and say, okay, this one sounds good with this file.
It's probably the deductible. I don't know. No, just kidding. The other thing I have seen too is promissory notes, although those really kind of went away after 2010.
They have.
2009, I saw a lot of promissory notes at short sale approvals, but for the most part, they've gone away.
They're unsecured debt. So
yeah,
they figured that out. It sounded good. It looked good in the approval letter, but in the end, it's unsecured debt.
Right, exactly. Okay, so next question is, how long does a PMI company have to sue you on a short sale? The statute of limitations is being debated right now. They're definitively within the bill, I think it was AB 414, but it dealt with the ability to pursue after deficiency. And the legislative discussion that happened, if you go back, you can go to the state's website and read what all the different senators and assemblymen said about the bills as they were coming through. And as a legal practitioner, anytime we have new laws, we always go back and read those because that helps us formulate our arguments when we defend or we prosecute new laws. You have to know the legislative intent because there's no case law. So the judges haven't interpreted the laws yet. So it's real difficult for us to say 100% what will happen with regard to the new laws until somebody interprets them. Laws that have been around a long time, we generally know how they're going to be perceived, and so it's a lot easier to give 100% or as close to 100% as you can ever be in the state of Nevada on legal issues advice. with regard to these new laws, it's going to be debated. But looking at the legislative intent, what was represented on the Senate side of it when they were talking about the statute of limitations was that they were under the presumption that a first deed of trust would always waive deficiency in a short sale, which is the reason for doing the short sale, and that the seconds would always be the holdouts not waiving deficiency and therefore exposing someone to a 6 years of statute of limitations to be sued on a breach of contract. Similarly, after a foreclosure sale, the first under the one action rule only has 6 months to pursue for a deficiency, and but yet the second, as a sold out junior lien holder, would have 6 years because they're not bound by the one action rule. They're now in a position of suing on breach of contract. So having 6 years either way as a second, whether you did a short sale or a foreclosure, really was mucking up being able to get short sales done and made a lot of people leery to participate in short sales. In fact, most people at that point, if you had a second, they just send you right over to a bankruptcy attorney because there was no sense in if you couldn't get a deficiency waiver from the second.
Right.
So now I think what they're trying to do is to make it an even playing field, so that, you know, instead of telling someone, well, hey, in a short sale they're going to have 6 years to come after you, but after a foreclosure there's only 6 months, which kind of made most people say, well, why would I do a short sale when I only have this much liability space? I'm going to go for the foreclosure. So what they're trying to do is encourage more short sales. So that was the intent of the legislature. However, the way that 414 was crafted, it's not exactly clear that the first deed of trust was specifically being changed as far as the statute of limitations after a short sale is concluded. It is specific that in a second deed of trust, whether it's a foreclosure or it's a short sale, they have 6 months to pursue unless they waive deficiency. There's also going to be changes with regards to how they do their deficiency waivers. If they don't specifically reserve the rights, we may have arguments to the fact that silence or ambiguity is going to be construed against them. So again, after August 22nd, and I can see how the statutes are going to be worded, I'll feel more comfortable.
Reinterpret what it's going to mean.
Exactly, how it's going to play out. But I think it's still going to have the same desired effect, which is that banks are going to say, yeah, sure, we'll waive deficiency. Because in 6 months, you know, there's no way we're going to be able to file a lawsuit, so we might as well get the deal done now rather than you just let it go to foreclosure and wait that time period out.
And that's what I'm seeing, and that's what I'm talking to my people about. You know, just, you have to do it. You have to start somewhere. You can't just sit there.
Right.
And everyone has been so... We've all programmed everyone to, oh, you got to be looking for deficiency waiver, deficiency waiver. Those have been the two words that have been standing out and looking for in every approval letter. Now I'm seeing approval letters with new verbiage in it.
Right. You also have to think these banks are national banks. They're dealing with 50 states and 50 state laws, and they're all different. And, you know, real property laws in New York are nothing like real property laws in Nevada. So, you know, and most of these banks are on the East Coast.
Right.
And so the predominance of their contracts laws are going to be driven by their in-house counsel that went to school and practiced law on the East Coast.
Right.
So, yeah, the wording's not ever going to be what we like in Nevada.
Right.
Because there aren't any banks that are coming, that are set up shop here, that are creating it.
Yeah.
So most of the time those approval letters are going to say a variety of things, and that's why you want an attorney to look at it and determine whether or not they're releasing you of the deficiency. We use the term deficiency out here because that's what's in our statute, but if they say it's a full release and satisfaction of the contract or the loan or the deed, or
and forever satisfaction of indebtedness.
Right.
There's lots of new words in these approval letters now.
Yes.
So I don't want everyone to get scared and thinking, oh, it doesn't say deficiency waiver. Don't get scared.
Right.
Just go have it interpreted.
Well, and I can see that from a contract perspective, because until someone gives what that value of the property is and adds up all the costs and all these other things, what is the deficiency?
Exactly.
So we don't know what it is.
We don't know. So the indebtedness, I like that word better.
Well, I wouldn't say that. As a lawyer in Nevada, I like it to say the deficiency is being waived, because that makes sense to our judges. So, but yes, I mean, so if you're not sure, your real estate agent isn't sure, I mean, and even if they are sure, you still should probably take it to a lawyer and have them look at it and give it, you know, the blessing that it's going to really release you.
Right.
And the other thing too is people say, well, okay, so they can't sue me. Okay, anybody can sue
anybody at any time.
Anytime for any reason. What we want to make sure is that you have adequate defenses in the case that they do. Right. And so that type of language saying that there's been a full release and satisfaction of the debt, that gives you a really strong defense. That, you know, under no sense and circumstances were you under the impression that you owed any additional money.
Right.
And with regards to the PMI companies, I'll tell you this. I know a lot of people don't like to come out of pocket, but if you can come out of pocket even for a small amount, if they do come back after you saying that they didn't waive deficiency, that they were, you know, offsetting something on their books with regards to contribution, you can still make an argument that, you know, given the language and the terms that have been put out there on the table, that contribution was a satisfaction and accord of that original contract. So when PMI companies are involved, I actually like to see money exchange hands because those are the instances where they don't seem to sue. Right. So
even if they come back with one amount, you still can counter that amount.
Oh, sure.
It's never written in stone.
Right.
You can always go back and, you know, go in for half of what they're asking for.
Right.
And you just got to go back and forth. That's the negotiating work of the realtor. That's where the realtor is going to do their job.
I mean, if you're in your bank statements, you've got $10,000 in your savings account, and then you try to tell them you don't have that.
Right. I'm sorry.
then you have a problem. But if they ask for $10,000 and you've got $200 in your bank account, well, yeah,
yes.
Come back and negotiate it. Let's see. Okay, another question. If you refinanced your HELOC to avoid the balloon payment and refied it into a home equity loan, is it more difficult to short sell? Well, here's the first thing I would say. You need to go see a CPA because anytime there's a cash refi, the Mortgage Debt Relief Act most likely will not apply. That money has to have been used for the purchase of the property or to substantially improve it. Now, you still may have, there's other tax provisions, which is why I advise to go see a CPA, because I'm not one, or a tax attorney. I know what the laws are that are out there that deal with these issues relative to real estate. I know enough to know that you need to go see CPA. So, you know, they can argue insolvency. There's some other provisions, but you have to add up all of your assets and your debts to see if you're going to qualify for that. But I do know that when there is a cash out refi, it is much, much, much more likely that you're going to have a tax issue. So that's really where you need to start there. As far as getting the short sale done, it makes no difference whatsoever. None. Because to them, all of these transactions are the exact same. It's whatever's on the balance sheet. What the money was used for, how it was originated, they don't care.
No.
I've never ever had that issue come up.
No. And the few that I've had that have used the money to improve the property, and they've been able to prove it.
Right.
So, you know, it just depends on what you did, and you need to talk to your CPA and figure it out.
Right.
And if you used it for the house, then you got nothing to worry about.
Right. Yeah. I mean, if it's used for a pool, I mean, even if it was a luxury upgrade, as long as it was used on the proproperty, that's going to benefit you.
And not to go buy your Harley Davidson, then we're good.
Or pay off your credit cards. That's more often what people were doing. But as far as, you know, the bank approving the short sale, you know, the only challenge I'd say that we're seeing in the HELOCs is that they're just more difficult to negotiate with.